Imagine a company that makes a very ordinary product. Not something glamorous. Not something that dominates the headlines. It makes specialized packaging used by food and pharmaceutical companies. For years, the business has been steady. Sales grow slowly. Profits move gradually. The share price rarely attracts attention. Then management announces something unusual. The company is building a highly automated production facility. The new facility should eventually produce much more than the existing factories. But for the next 2 years, the story becomes messy. Money has to be spent before the new capacity starts generating meaningful profits. Operating costs increase. Depreciation rises. The company hires new employees. Training costs increase. And suddenly the financial statements look less impressive. An investor looking only at the next few quarters might become uncomfortable. The earnings are under pressure. The costs are increasing. The share price may weaken. The obvious conclusion is that something has gone wrong. But what if the opposite is happening? What if the company is going through a period of temporary weakness because something much more important is being built underneath the numbers? That is where the question of when to buy becomes much more interesting. Because buying a stock is not simply about finding a good company. It is about recognizing when the future of that company is beginning to become more valuable than the market currently understands. Philip Fisher spent considerable attention on this problem. The difficult part is that investors naturally want certainty before they invest. They want to know exactly what the economy will do, exactly what interest rates will be, exactly when demand will rise, exactly when the market will turn, exactly when the stock will reach its lowest point. But there is a problem. The future does not provide that kind of certainty. Economic forecasts can disagree. Market predictions can change. Experts can be confident 1 month and completely change their view a few months later. And even when the broad economic forecast is correct, it may tell you very little about the individual company you are considering. Imagine two companies operating in the same industry. The economy slows. Demand becomes weaker. The industry faces uncertainty. One company struggles badly. The other uses the slowdown to modernize its operations. It cuts unnecessary costs. It improves productivity. It develops new products. It strengthens its distribution. It prepares for the next period of growth. The economic environment is the same, but the businesses are behaving differently. That difference is what the investor should be watching. This leads to a powerful idea. Instead of trying to predict every movement in the economy, ask whether the company itself is moving in the right direction. That sounds much easier, but it requires patience. Because the market does not always reward improvement immediately. Go back to our packaging company. The new facility is being constructed. For a while, nothing seems to happen. The company spends money. The earnings remain under pressure. Investors become impatient. Some begin selling. Others say management has made a mistake. The stock price weakens. Then something changes. The new production line begins operating. At first, there are problems. Machines need adjustment. Employees need training. Production is not yet running at full efficiency. Unexpected expenses appear. The company reports another disappointing quarter. The market becomes even more negative. But management knows something the market may not fully appreciate. The difficult part is nearly finished. The factory is beginning to operate properly. Orders are increasing. Production efficiency is improving. And once the basic costs are covered, every additional unit produced can contribute much more to profits. The financial results have not yet fully reflected the change. But the economics of the business are beginning to change. This is where timing becomes important. The best moment is not always when everything looks perfect. By the time everything looks perfect, the market may already have recognized it. The opportunity can sometimes appear when the business is improving, but the financial numbers still look ordinary. That does not mean every weak quarter is an opportunity. That would be far too simple. Temporary weakness can also become permanent weakness. A failed project can remain a failed project. A poor management team can continue making poor decisions. A declining industry can keep declining. So the investor needs something more than a falling price. There has to be evidence of change. The question becomes, what has actually changed inside the business? That question separates a genuine opportunity from a cheap-looking stock. Consider a company that has lost half its market value. One investor sees a bargain. Another sees a warning. The price is the same for both investors. Their conclusions are completely different. Why? Because the price tells you what the market is currently offering. It does not tell you whether the underlying business is improving. A stock can fall because investors have become too pessimistic. But it can also fall because the business has genuinely deteriorated. Those situations look identical on a price chart. The difference exists underneath the price. This is why timing should never be separated from business quality. Suppose a company has an excellent management team. It has a strong research program. It is developing products that could open new markets. It has a healthy financial position. And it is investing aggressively in future capacity. The current earnings may not fully reflect what the company is building. That can create an interesting situation. The market may judge the company using today's earnings, while the long-term investor is thinking about what those earnings could become after the investment cycle is complete. But there is another danger here. Investors can become too enthusiastic about future possibilities. A new product can sound spectacular. A new factory can sound transformational. A new technology can sound revolutionary. But promises are not profits. A project has to work. Customers have to adopt the product. Production has to become efficient. Costs have to remain under control. And management has to execute. This is why the period between announcement and success can be so difficult. The investor has to balance optimism with evidence. Imagine a company developing a new battery material. The laboratory results are encouraging. Management believes the technology can eventually become commercially important. The market becomes excited. The stock rises. Everyone begins talking about the future. But the real test has not arrived. The company now has to move from laboratory success to large-scale production. That transition can expose problems nobody could see earlier. The material may be difficult to manufacture consistently. Production costs may be too high. Customers may demand changes. The equipment may not work as expected. The process may require much more time. This is why the investor should not confuse scientific promise with commercial success. The transition from an idea to a profitable business is where many dreams are tested. And sometimes that transition creates the opportunity. A company may encounter problems during the early stage of development. The stock may fall. Investors may lose patience. But if management solves the problems and the underlying economics remain attractive, the situation can change dramatically. The market that once saw failure may eventually see progress. The important thing is to identify whether the problem is temporary or structural. That distinction appears repeatedly in investing. Temporary problems can create opportunities. Permanent problems create traps. The difficulty is knowing which one you are looking at. This is where management becomes extremely important. Imagine a company facing a serious operational problem. Two management teams could react in completely different ways. The first team blames external conditions. It delays difficult decisions. It protects its own position. It avoids admitting mistakes. The second team attacks the problem. It changes the organization, replaces inefficient processes, invests when necessary, cuts waste, improves productivity, and measures whether the changes are actually working. The company may still report weak earnings for some time, but the direction has changed. That direction can matter more than the current number, because earnings are the result. Business improvement is the process. And the investor who notices the process before the result becomes obvious may sometimes have an advantage. This is why buying opportunities can appear during periods that look uncomfortable. The market prefers certainty. But real business improvement is often messy. A company can spend money before it earns money. A new product can cost money before it generates revenue. A new facility can reduce profits before it increases capacity. Management changes can create disruption before they create efficiency. Research can consume resources before it produces a commercial product. The investor needs to understand this difference. Otherwise, the market may punish a company for doing something that could eventually make it much stronger. But there is an important limit. Not every investment program creates value. A company can spend heavily and achieve very little. A large project can become a financial burden. A new facility can produce below expectations. A new product can fail. A management turnaround can remain only a promise. So the investor must ask whether the improvement is economically meaningful. Suppose a company spends 100 rupees to create an additional 150 rupees of sustainable annual profit. That investment could transform the economics of the business. But suppose another company spends the same amount and produces only a small increase in profits. The headline investment may look identical. The economic value is completely different. This is why the quality of the opportunity matters more than the size of the project. Another important mistake is trying to wait for the perfect moment. Some investors believe they should buy only at the exact bottom. But nobody knows the exact bottom in advance. Waiting for perfect certainty can mean waiting until the opportunity has already disappeared. If the business begins improving, if the evidence becomes stronger, if management is executing, and if the long-term opportunity remains attractive, then trying to predict the exact lowest price may become less important than recognizing the change in the business. The reverse is also true. If the business is deteriorating, waiting for the stock to become even cheaper does not necessarily make it attractive. The investor has to focus on the business rather than becoming obsessed with the number on the screen. This becomes particularly important for investors who already own several stocks. Suppose someone has a portfolio filled with companies that have already performed well. They now have fresh money to invest. The temptation is to put the money into whichever company has recently gone up the most. But the better question is different. Where is the best opportunity today? It may not be the stock that has already risen dramatically. It may be a company whose business is improving, but whose market recognition is still developing. This is where patience becomes part of the investment process. You do not need to buy everything at once. If the opportunity is genuinely long-term, there may be several occasions to invest. This can reduce the pressure to predict the exact market bottom. It also creates an important psychological advantage. You are no longer forced to make one perfect decision. You are allowing the business to provide more evidence over time. But there is another side to this. A long-term investor must also understand the economic environment. Interest rates matter. Government policy matters. Inflation matters. Business cycles matter. The overall economy can influence almost every company. But the danger is becoming so focused on these forces that you stop studying the individual business. The economy is a huge machine. A company is a much smaller system operating inside it. You may not be able to predict every movement of the larger machine. But you can sometimes understand whether the smaller business is becoming stronger or weaker. That is a much more practical form of analysis. And it changes how you think about buying. Instead of asking, the market may still be doubtful. The financial results may still be incomplete. And the future may still be impossible to predict precisely. But that does not mean there is no opportunity. Sometimes the opportunity exists because the business is changing faster than the market is changing its opinion. That is the gap an investor is trying to understand. Not a prediction, not a guarantee. A gap between business improvement and market recognition. And once you start looking at stocks this way, the question of when to buy becomes much more intelligent. You stop searching for a magical date. You stop waiting for a perfect market forecast. You stop believing that the lowest price is automatically the best price. Instead, you watch the business. You watch management. You watch the economics. You watch the evidence. And you ask whether the original reason for buying is becoming stronger. Go back to the packaging company. At the beginning, the new factory looked like a problem. Costs were rising. Profits were under pressure. Investors were uncertain. But eventually the machines began running efficiently. Customers began placing larger orders. Production improved. The new capacity started contributing to earnings. And suddenly the same investment that once looked like a burden began to look like the foundation of the next stage of growth. The factory did not suddenly become valuable on the day the stock price recognized it. Its economic value had been developing long before the market fully appreciated it. That is the deeper lesson about timing. The investor is not trying to predict the clock. The investor is trying to recognize change. Because the best buying opportunity may not appear when everything looks perfect. It may appear when the business is becoming better while the evidence is still incomplete. That is when patience and judgment matter most. The market will always ask you for a price. Your job is to ask a better question. What is changing underneath that price? Because a low price is not an opportunity by itself. A high price is not a warning by itself. A rising market is not proof that you should buy. A falling market is not proof that you should wait. The real opportunity begins when the economics of the business and the price of the stock begin telling two different stories. And the investor who can understand why those stories are different may begin to see something that others are missing. Not the perfect moment, but the moment when the future is becoming more valuable than the market has yet realized. That is when buying becomes more than timing a stock. It becomes understanding a business. And every stock has a business behind it. Every business has a changing story. The investor who learns to recognize that change may not know exactly what happens tomorrow, but may understand much better why the opportunity exists today.